Imagine waking up on a Monday morning. You sit down at your desk, you're staring at your trading screens, and you are managing billions of dollars.
Right.
And you suddenly realize that you are entirely, catastrophically on the wrong side of the largest financial crash in modern history.
Oh, wow. Yeah.
It's October 19th, 1987, Black Monday.
A literal nightmare scenario.
Exactly. And you aren't just invested in the stock market, you are leveraged 130% long.
Which is just wild.
Right, because that means you've poured every single dollar of your capital into the market, and you've actually borrowed another 30% on margin just to buy even more.
Yeah, you're completely overextended.
And then the opening bell rings, and the market doesn't just dip, it completely falls off a cliff.
Yeah, the tape is just bleeding red.
Exactly. Liquidity is vanishing, the clearing houses are basically on the verge of default, and your portfolio is evaporating by the second. Like, what do you do?
Well, most people would freeze.
Right. They'd grip the desk, maybe close their eyes and just pray for a rebound. They'd go down at the ship.
Yeah, human nature is to just freeze in panic.
But the man in this exact scenario didn't freeze. He executed one of the most ruthless, ego-destroying maneuvers in financial history, and he actually finished that very same month in profit.
Which is just staggering when you really unpack it.
Yeah.
And, that man was Stanley Druckenmiller.
Yeah.
And his survival on Black Monday is really the perfect entry point into the absolute treasure trove of source material we're cracking open today.
It's incredible stuff.
It really is. We are pulling from interviews, historical trading data, and some deep research compiled from the text, The New Market Wizards.
Right.
We are analyzing 5 of the most elite, world-class traders to ever interact with the global markets. So we're talking about Stanley Druckenmiller, Richard Driehaus, Gil Blake, Monroe Trout, and Al Weiss.
A really diverse group.
Extremely.
Mhm.
And the mission here isn't just to, gawk at their mind-bending financial returns. The objective of this deep dive is to decode their structural mechanics.
Right. How they actually do it.
Exactly. Because we are looking at 5 individuals who use completely, almost hilariously contradictory methods to extract money from the market.
It's so true. You have everything from global macroeconomic tidal waves to a guy who studies 150-year-old price charts of 19th century commodities.
Yeah, they couldn't be more different on paper.
Yet, despite those totally opposing methodologies, the sources reveal a shared psychological DNA.
That's the real secret sauce.
It is. It's a structural approach to risk and human emotion that they all just have in common. Think about your own portfolio for a moment.
Right, the anxiety of holding a losing stock.
Yeah, or that massive urge to cash out a winner way too early just to feel safe.
Oh, absolutely.
So just to be clear, this deep dive is not some get-rich-quick manual. If you're listening to this hoping for a hot stock tip or like a magic algorithm to run on your laptop, you are going to be pretty disappointed.
Yeah, definitely look elsewhere for that.
Because this is an exploration of extreme behavioral control. The financial markets are essentially this giant global mirror reflecting human greed, panic, and cognitive bias right back at us.
It's pure psychology.
Right. And these 5 traders mastered the market because they first mastered the ultimate psychological liability, which is themselves.
That's beautifully put. Which really brings us back to Stanley Druckenmiller.
Right.
And the actual mechanics of his survival.
Let's get into it.
So Druckenmiller operated in the realm of global macro, top-down investing. He wasn't spending his time analyzing the quarterly widget sales of some mid-cap tech company.
Right. He's not looking at the micro details.
No, he was looking at the tectonic plates of the global economy. Shifting interest rates, central bank policies, currency valuations, sovereign bond yields.
He's playing 3-dimensional chess with massive pools of global liquidity.
Exactly. And over a massive capital base, he generated an average annual return of nearly 40%.
Which is just, 40%.
It's mathematically staggering. In the institutional world, maintaining a 40% annualized return on billions of dollars over decades is almost unheard of.
The scale is just massive. But, the October 1987 story really highlights that a macro view is totally useless without microscopic psychological flexibility.
Oh, totally.
Let's walk through the actual mechanics of that weekend, because Druckenmiller had been running a massive short position, right?
Right. He was betting heavily that the stock market was going to decline.
Which was the mathematically correct place to be at the time.
It was. He had it right.
But then on Friday afternoon, literally right before the crash, he's looking at the price action and the market sentiment, and he second guesses his own premise.
Right. He talks himself out of it.
Yeah. He decides the market has actually found a bottom, and he doesn't just cover his short position to go to cash and play it safe.
No, he goes all in.
He flips entirely. He leverages up to 130% long. He goes home for the weekend betting the farm on a market rally.
And the structural plumbing of the market on Monday morning is crucial to understand here. Because when the market opened on October 19th, it wasn't just a normal sell-off.
Right, it was a systemic failure.
Exactly. The actual mechanisms of liquidity broke down. Market makers stopped answering the phones.
Wow.
Yeah, sell orders piled up with literally zero buyers on the other side. So 130% long position in that specific environment is a death sentence because of margin calls.
Right. Explain how that works for people who might not trade on margin.
Sure. So if your account value drops below a certain threshold, your broker will forcefully liquidate your assets at the absolute worst possible prices just to cover the money they loaned you.
They don't ask for permission.
Not at all. They just sell it. So Druckenmiller was staring down total financial ruin that morning.
And this is where the psychology separates the amateur from the wizard. Because for a normal investor, the ego instantly attaches to that Friday decision.
Oh, completely. You want to be right.
Yeah. The human brain frantically searches for confirmation bias. You start telling yourself, the Federal Reserve will step in, or this is just a temporary computer glitch. It's going to bounce back.
You rationalize it.
Exactly. You rationalize the pain. But Druckenmiller did none of that.
He's just faced the music.
The very moment the market opened and he saw the catastrophic price action, he realized his Friday thesis was fatally flawed.
Right.
Within the first hour of trading, right in the middle of a historic panic, he aggressively liquidated his entire 130% long position at a massive, agonizing loss.
The concept at play here is what I like to call absolute disloyalty to a position.
I love that phrase.
Yeah, a position does not know you own it. It owes you nothing.
Right.
Druckenmiller killed his ego the moment the empirical data proved him wrong. But the crazy part is, he didn't just sell and walk away to lick his wounds.
No, he kept going.
Because he was able to detach his emotions from the massive loss he just took. His mind was actually clear enough to recognize the new reality.
Which was that the market was going much, much lower.
Exactly. So within that same hour, he immediately established a massive short position. He reversed direction while the ship was actively sinking.
And because he executed that 180 turn without hesitation, the profits he generated from shorting the market for the rest of Black Monday and throughout the rest of the month completely offset the catastrophic losses from his initial Friday mistake.
It's unbelievable.
He actually finished October in the green.
I mean, that requires a suppression of human nature that is almost sociopathic.
Truly. You have to endure the pain of admitting a massive failure, taking the financial hit, and then immediately re-entering the danger zone in the opposite direction.
It perfectly encapsulates his core philosophy, which requires two really distinct elements.
Right.
Radical preservation of capital, which we just saw, combined with an aggressive pursuit of home runs.
Right. He's not looking for singles.
No, the sources really emphasize Druckenmiller's belief that superior performance is impossible if you are only hitting singles. When your macroeconomic thesis is playing out exactly as anticipated and the market is basically handing you a massive trend, taking small, comfortable profits is a mathematical error.
He has that incredibly blunt quote in the source material, it takes courage to be a pig.
Yeah, it's a famous one.
It sounds so crude, but the underlying risk asymmetry is really profound. Think about the instinct of the average retail investor. You buy a stock, it goes up 15%, and you immediately feel anxious.
Oh yeah, you want to lock in the win.
Exactly. You take the chips off the table so you can feel smart. But Druckenmiller argues that when all the macroeconomic stars align, when the central banks, the currency trends, the momentum are all at your back, that is the exact moment you must press your advantage.
You don't cash out, you double down.
You leverage up. You maximize the position to extract every possible dollar because those rare, massive asymmetric trends are what pay for all the small, inevitable losses you're going to take along the way.
It's the synthesis of immediate, ruthless risk control on the downside and aggressive, almost greedy expansion on the upside.
Exactly.
So he swings for the fences based on global macro dynamics. But, the beauty of the markets is that there are infinite ways to solve the puzzle.
Very true.
Because if we transition to our second trader, Richard Driehaus, we see someone who also swings for the fences. and generates massive returns. But he does it by ignoring the macroeconomic ocean completely.
He basically breaks every traditional rule of prudent investing that financial advisors have preached for a century.
He really does. Driehaus is the undisputed master of bottom-up momentum investing.
Right.
If Druckenmiller is analyzing the global tides, Driehaus is putting a microscope on a single, highly specific type of fish. He isolates individual, high-growth, small-cap stocks. And his entire philosophy is a direct assault on the golden rule of investing.
Which we're all taught is buy low, sell high.
Right. You look for bargains, you find a beaten-down company that the market is undervalued, and you wait for it to recover.
But Driehaus throws that totally out the window.
Completely. His operating motto is buy high, sell higher.
Buy high, sell higher. It fundamentally challenges how standard market participants perceive the entire concept of value.
Yeah, because Driehaus actively seeks out stocks that have already experienced massive price movements.
Right.
He scans for equities demonstrating extremely high relative strength compared to the broader market indices. And he is perfectly comfortable. In fact, he actually prefers buying companies that boast astronomical price to earnings, or PE ratios.
Okay, let's pause here. He routinely buys stocks with PE ratios of 60 to 1, 80 to 1, or even higher, right?
Yes.
Let's stop and really walk through the actual arithmetic of that, because conventional wisdom screams that this is financial suicide. Oh, it terrifies value investors.
Right. A PE ratio of 60 means you are paying $60 for every $1 of earnings the company currently generates.
Okay.
To the average value investor, that looks like a massive bubble. It feels like you are, boarding a rocket ship right as it's running out of fuel.
You're just asking to be the greater fool who buys at the absolute top.
Exactly. So why is the conventional wisdom here fundamentally flawed, according to Driehaus?
Because conventional wisdom treats earnings as a static number.
Okay.
Value investors buy a stock with a low PE, say 10 to 1, because it's cheap. But Driehaus points out that a stock is usually cheap for a very good reason.
Like what?
The company is stagnant, the management is poor, or the industry is dying. You end up holding a portfolio of permanent underperformers just waiting for a turnaround that never materializes.
Right. It's a value trap.
Exactly. Driehaus understands that price is a slave to growth velocity. Let's do the math on a high PE stock.
Let's do it. Imagine a small cap tech company trading at $60 a share, earning $1 a share. That's a 60 PE. It looks terrifyingly expensive.
Right.
But what if that company's product is exploding in popularity and next year they earn $3 a share?
Okay, wow.
Suddenly, at that current $60 price, the PE drops to 20. The fundamental growth of the company actually compresses the multiple.
So the earnings catch up to the price.
Exactly. And when the market realizes the earnings velocity is real, institutional money floods in, driving the stock from $60 to $120.
So the high price and astronomical PE aren't warning signs at all. They are glaring signals of extreme institutional demand and underlying momentum.
Right.
But Driehaus is really capitalizing on the sheer psychological discomfort of buying into extreme strength.
Oh, it's incredibly uncomfortable.
Put yourself in the shoes of a normal investor again. A company releases a blockbuster earnings report. The stock gaps up 20% the second the opening bell rings.
Yep.
The amateur looks at that chart and says, damn, I missed the move. I'm not paying a 20% premium. I'll wait for the stock to pull back and dip, and then I'll buy in at a reasonable price.
And the tragedy of that mindset is that for true market leaders, the dip never comes.
It just keeps going.
Right. The stock gaps up 20%, consolidates for maybe 2 days, and then runs another 40% over the next 3 months.
And the amateur is just left standing on the platform watching the train disappear.
Exactly.
Yeah.
Driehaus forces himself to suffer the psychological discomfort of buying that stock right at the top of the 20% gap up.
Wow.
He knows that if the fundamental news is significant enough, like a revolutionary new product or a massive beat on earnings, the entire valuation trajectory of the company has permanently shifted.
He actually provided some staggering historical data in the sources to back up why you absolutely must be exposed to these fast-moving stocks.
Yeah, this data point blew my mind.
It's crazy. It shows why the amateur habit of trying to time the market by jumping in and out is mathematically disastrous.
Right.
He looked at market data stretching from 1980 onward. The market realized an average annual return of roughly 17% during that period.
Which is fantastic.
It is. But if an investor tried to get clever, hopped in and out of the market, and accidentally missed the 40 best trading days of that entire multi-decade period, which, by the way, represents a mere 2% of the total trading days.
2%. That's nothing.
Their average annual return plummeted from 17% down to under 4%.
Missing just 2% of the days completely decimates your wealth compounding.
It's wild.
And we have to analyze when those 40 best days historically occur. They do not happen when the sky is blue and the news is universally positive.
Right.
The most explosive single-day market rallies almost always occur immediately following massive sell-offs. Right in the middle of bear markets, when the public is paralyzed by fear and sitting in cash.
So they're missing the bounce.
Exactly. Driehaus's methodology of staying heavily invested in the strongest growth stocks and just enduring the terrifying volatility ensures he is fully exposed when those violent upside days hit. The penalty for being on the sidelines is simply too severe.
So Driehaus really proves that absorbing massive volatility and ignoring traditional valuation metrics is one way to achieve spectacular returns.
Yep.
But absorbing that kind of volatility requires an iron stomach. What if human psychology fundamentally rejects that kind of stress?
Which is true for a lot of people.
Yeah. If you are listening to this and thinking, I cannot mentally handle holding a stock with an 80 PE ratio that swings 10% a day.
Yeah.
Is there a mathematical way to extract incredible returns but smooth the equity curve out into basically a straight line?
And that perfectly brings us to our third trader, Gil Blake.
Yes, Gil Blake.
If Druckenmiller and Driehaus are the home run hitters who strike out occasionally but hit the ball out of the park, Gil Blake is the guy who simply hits a single place there every single time he steps up to the plate. The consistency of his track record is almost difficult to comprehend within standard financial frameworks.
It really is.
Over a monitored period of 139 months of trading, Gil Blake was profitable for 134 of those months.
134 winning months out of 139. And he wasn't just scraping by making, savings account yields.
No, not at all.
He generated an average 45% annual return.
Incredible.
But the most fascinating part of Blake is his origin story.
Oh, I love this part.
Right. He didn't come from Wall Street. He was a former submarine officer and an accountant. He literally only became a trader because he was having a debate with a colleague about market theory.
Yeah, he was debating the random walk theory.
Which is what exactly?
So the random walk theory is a cornerstone of the efficient market hypothesis, which is taught in traditional financial academia.
Right.
The theory basically posits that market prices represent a random walk, meaning that all public information is instantly and perfectly priced into an asset, making it impossible to consistently predict future price movements or beat the market without taking on excessive risk.
So it's all just random noise.
So that's the theory. So Blake, being an accountant and a numbers guy, decided to pull the historical data to definitively prove to his friend that the markets were indeed random.
He was trying to win an argument.
Exactly. But in the process of crunching the numbers, he accidentally discovered highly predictable mathematical pockets of non-random behavior.
He set out to prove it couldn't be done and accidentally built a money printing machine.
Basically, yeah.
Let's dig into the actual mechanics of his strategy, because this isn't about picking the next Apple or shorting a currency. Blake utilized a mutual fund timing strategy.
Right.
He was looking at specific sector mutual funds, like a healthcare fund or a utility fund. And he exploited the structural plumbing of how mutual funds were priced in the 1980s.
This is a crucial historical nuance, because unlike stocks or ETFs today, which trade dynamically second by second, traditional mutual funds in that era calculated their net asset value, or NAV, only once a day.
At the 4 p.m. market close.
Exactly.
Yeah.
So Blake developed purely quantitative technical models to measure the short-term price momentum within these specific sectors.
Okay.
If a sector showed positive momentum based on his algorithms in the morning,
Yeah.
he knew with high statistical probability that the momentum would carry through to the end of the day and likely the next day.
So what would he do?
He would submit an order before the cutoff to switch his capital from a safe money market cash fund into the trending sector fund.
He was essentially exploiting a pricing lag.
Yes.
He would catch a tiny 1 to 4 day wave of momentum in a sector fund, capture a fraction of a percent of profit, and then immediately transfer the capital back to the safety of a cash money market account.
The ultimate quantitative arbitrage.
Yeah. He didn't care about the macroeconomic state of the world. He didn't care who the CEO of the companies in the fund were.
None of it mattered to him.
He was operating like a card counter in blackjack. He mechanically played a tiny proven mathematical edge over and over and over again.
But here is the problem with mathematical edges.
The casino always fights back.
Exactly. Markets are dynamic. Once an inefficiency is discovered, capital floods in and closes the gap.
And the mutual fund companies absolutely fought back.
Oh, they hated it.
Yeah, a firm like Fidelity realized that traders like Blake were using their funds as short-term trading vehicles, rapidly switching millions of dollars in and out on a daily basis.
Which creates massive overhead and liquidity issues for the fund manager.
Exactly. So Fidelity changed their rules. They imposed prohibitively high fees and lockup periods specifically designed to kill the rapid daily switching strategy.
Right, and for the vast majority of system traders, if the structural rules of their specific game are outlawed, their career just ends.
Yeah, they throw their hands up, blame the system, and quit.
But Blake's true genius wasn't the original algorithm. It was his adaptability.
He didn't give up.
No. When Fidelity changed the rules, he didn't dig his heels in or try to force a broken system to keep working. He seamlessly evolved.
How so?
He took the core mathematical concepts of momentum and volatility, and he adapted them to entirely different fund families that had different prospectus rules regarding switching.
Ah, clever.
Yeah, he researched new algorithms that required slightly longer holding periods to avoid the new fees.
So to maintain a mathematical edge in the financial markets, you have to treat the market as this constantly mutating puzzle that requires relentless recalibration.
It highlights a profound difference between a trader and an investor.
Right.
An investor marries a thesis. A quantitative trader like Blake marries the math. When the variables in the math change, the execution changes instantly without any emotion.
Which perfectly sets up our fourth trader.
Yes.
He also approaches the market as a cold mathematical puzzle. But he recognized that pure math eventually falls victim to exactly what happened to Gil Blake, where systems degrade. So this trader combined rigid statistical models with an incredibly raw, visceral human element. We are talking about Monroe Trout.
Monroe Trout. And once again, the performance metrics here are just staggering.
Let's hear them.
A 67% average annual return over a 5-year period.
Wow.
But here is the real kicker. He achieved that 67% annual return with a maximum drawdown of just over 8%.
Okay, to properly contextualize that, we really need to define what a drawdown is.
Good point.
That's
So,
all.
a drawdown is the percentage drop in your account equity from its highest absolute peak to its lowest subsequent valley.
Okay.
So if you have $100,000, it grows to $150,000 and then falls to $120,000, you have experienced a 20% drawdown from the peak.
Got it.
Now, achieving a 67% annualized return usually requires massive leverage and stomach-churning drawdowns of 30, 40% or even more.
Right, you have to take big risks to get big rewards.
Usually.
Hmm.
But generating 67% while never allowing the portfolio to dip more than 8% from its high watermark, that is the holy grail of quantitative finance.
It's unheard of.
It represents an almost mathematically perfect Sharpe ratio, which is basically the ultimate return per unit of risk taken.
So how does he mathematically achieve that? Because Trout runs dozens of sophisticated proprietary computer models, right?
Yes.
He is looking for statistical anomalies and price data across various futures markets. But the magic really happens because he doesn't blindly trust the computers to execute the trades.
Right, the computer's just a tool.
He uses the models to identify the setup, but the actual trigger is highly discretionary. And the best example detailed in the sources is a concept Trout refers to as the magnet effect.
Oh, the magnet effect is fascinating. It's built on the observation that financial markets are naturally, almost gravitationally drawn toward round numbers.
Give me an example.
So if the Dow Jones Index is trading at, say, 2950, Trout's models identified a high statistical probability that the index would be pulled upward to test the 3000 level.
Because it's a big round number.
Exactly. This happens because humans are cognitively obsessed with round benchmarks. Institutional algorithms are programmed around them. Option strike prices are clustered heavily at round numbers, and the financial media builds massive hype around them.
Right. Dow approaches 3,000.
Exactly. The round number acts as a literal magnet for capital.
So his computer models tell him the Dow is entering the gravitational pull of the 3,000 magnet.
Yes.
But the entry and the physical execution of the trade is where Trout's methodology gets really fascinating.
Because he's running a highly sophisticated quantitative fund. But when the market approaches that magnet point, he doesn't just stare at the flickering numbers on his terminal.
No.
In the late 80s and early 90s, the futures markets were traded in open outcry pits in Chicago.
Right. Hundreds of men in brightly colored jackets physically screaming orders at each other.
Pure chaos. And when Trout's computer signaled a trade, he would literally have his trading room clerks pick up a telephone, call the broker standing on the floor in Chicago, and just ask them to hold the phone up to the air.
Just to listen to the room.
Yes, so he could listen to the physical noise level of the pit.
That is incredible. He was measuring the literal acoustic volume of human panic and greed.
Exactly. Pure computerized systems, which became infamous years later with a collapse of massive funds like long-term capital management. They often fail because they assume markets are perfectly rational.
Right.
They assume price follows a normal distribution bell curve. But computers fail to account for the irrationality of human panic.
They don't know what fear sounds like.
Exactly. By listening to the floor, Trout was synthesizing quantitative modeling with real-time qualitative emotion.
Think of it like using a billion-dollar weather satellite to predict a storm, but still having the common sense to stick your hand out the window to feel if it's raining before you leave the house.
That's a great analogy.
So if Trout listened to the phone, and the floor sounded relatively quiet, with brokers trading standard, small lot sizes, he knew the momentum was entirely computer-driven and fake.
Right.
And he would dump his position immediately. But if the floor sounded like a literal war zone, guys, screaming at the top of their lungs, huge institutional paper being thrown around, he held on to the position.
Because he knew visceral human greed would violently push the market right through that magnet point.
And that qualitative synthesis was paired with the most ruthless risk control framework we've seen yet.
Oh, his risk control is legendary.
Trout did not rely on willpower to manage his losses. He relied on hard-coded rules.
Right.
He enforced a rigid 4% maximum daily loss limit. If his total account equity dropped 4% in a single trading session, he immediately liquidated every single position across the board, shut down his terminal, and went home.
The trading day was over. Period.
This acts as a circuit breaker for human psychology. Because when you are taking losses, revenge trading kicks in.
Oh, always. You want to make the money back immediately.
Exactly. So you double down on bad setups. The 4% rule completely removes the human capacity to spiral out of control.
It's so smart. Furthermore, he scales his position sizing mathematically based on his own performance streaks.
How does that work?
When he is winning, he assumes his models are perfectly in sync with the current market rhythm, and he aggressively increases his bet size.
He presses the advantage.
Right. But when he takes a series of losses, he assumes his models are out of phase, and he drastically shrinks his exposure down to almost nothing.
Wow.
He bets heavy when he has a hot hand and protects his capital the moment he goes cold. It is the exact opposite of the amateur who bets bigger when they are losing to try and average down.
Which usually just blows up their account.
Almost always.
Yeah.
So we've seen Trout use cutting-edge computers paired with the present moment auditory noise of a trading pit. But our final trader bypasses the present moment entirely.
This guy is fascinating.
He really is. He ignores the macroeconomic news cycle, he ignores the yelling in the Chicago pits, and he ignores the short-term mathematical arbitrage. He looks deep into historical antiquity to predict the future.
Al Weiss.
Al Weiss.
Over a recent 4-year period analyzed in the sources, Al Weiss achieved a 52% average annual return, and his worst annual drawdown was under 5%.
Again, phenomenal risk-adjusted returns.
And he achieved this using a purely technical approach, reading price charts.
Right.
But, technical analysis is a very broad, often maligned term. If you go on YouTube today, you'll find thousands of day traders drawing arbitrary triangles on a 5-minute chart of some cryptocurrency.
Yeah, that is definitely not what Al Weiss does.
Not at all. Weiss spent 4 isolated years doing rigorous, solitary research before he even risked a single dollar in the market.
4 years of just studying.
Yeah. He didn't look at the last 6 months of data. He studied continuous price charts going back 150 years.
He was analyzing the price action of commodity markets like wheat, corn, and cotton from the 1800s.
Which, to the average investor, sounds completely absurd.
Yeah, what does a chart of grain prices during the post-Civil War era have to do with the financial markets in 1990?
Exactly. But Weiss recognized a fundamental truth. Technology changes, asset classes change, and governments change. But human psychology, the pendulum swing between paralyzing fear and euphoric greed, has not changed in 10,000 years.
It's the one constant.
Yes. By looking at 150 years of data, Weiss was essentially cataloging the immutable graphic footprint of human emotion.
It reminds me of a chess grandmaster.
Oh, that's a perfect way to look at it.
A grandmaster doesn't just look at the 64 squares in front of them and guess the next logical move. They have memorized centuries of historical matches, every defense, every gambit. When they see a specific configuration of pawns and knights on the board, they instantly recognize the historical trajectory of that exact pattern. They know how the game ends before the opponent even realizes they are trapped.
And Weiss is doing the exact same thing with price charts.
Precisely. And he isn't looking for the basic elementary patterns like a head and shoulders that any novice can find in a textbook.
Right, he's going much deeper.
Much deeper. By utilizing a 150-year data set, Weiss looks for incredibly complex combinations, fractal patterns within patterns within patterns.
Wow.
He overlays these intricate price structures with long-term macroeconomic cycles. So we're talking periods of inflation, deflation, gold standard shifts, and banking panics.
He's contextualizing the patterns.
Exactly. He converts human psychology into graphic representations across a century and a half. By taking the data back that far, technical analysis stops being as objective, guessing game art and becomes a mathematically precise, statistically verifiable science.
But even with a 150-year statistical baseline, Weiss still possessed the qualitative wisdom to know when the human element completely overrides the math.
Right.
And just like Stanley Druckenmiller, the ultimate testing ground for Weiss was the 1987 crash.
Black Monday strikes again.
It does. Going into October 1987, Weiss was holding a massive short position in Treasury bill futures.
Okay.
Based on his historical cycle models, interest rates were rising, meaning T-bill prices were falling. His system said stay short.
Makes sense based on the model.
But as the stock market went into free fall on Black Monday, Weiss manually intervened. He overrode 4 years of statistical research.
Because he recognized the mechanics of a true panic.
Right.
When the equity markets violently crash, institutions and retail investors alike liquidate their stocks and desperately search for absolute safety.
They just want to hide their money.
Exactly.
Mm-hmm.
And in the global financial system, the ultimate safe haven is United States government debt.
Yeah.
Treasury bills. Weiss knew that a panicked public would instigate a massive flight to quality, shoving billions of dollars into T-bills.
Which drives the price up.
Right. This massive wave of buying demand would cause T-bill prices to skyrocket overnight.
Yeah.
If he remained short, he would be financially annihilated.
So he covered his short position and exited the market right before T-bill prices exploded upward.
It was brilliant.
He recognized that a 100-year statistical anomaly, a true systemic panic, renders standard models temporarily useless.
Yeah.
His system was perfectly calibrated for normal market conditions, but he had the wisdom to recognize when conditions were no longer normal.
Okay, we have excavated the methodologies of 5 completely distinct wizards.
We really have.
We have Druckenmiller trading the macroeconomic global tides, Driehaus buying sky-high small-cap stocks based on extreme earnings momentum,
Right.
Blake exploiting the daily pricing lag of mutual funds, Trout utilizing quantitative models mixed with the auditory panic of the trading pit, and Weiss decoding 150 years of graphic psychological history.
It's quite the lineup.
So how can 5 vastly different contradictory methods possibly all be correct?
And this brings us to the unifying theory of the elite trader. When you synthesize all the source material, the ultimate revelation is that the specific system isn't the secret.
Right.
The algorithm isn't the holy grail. The secret is the common psychological DNA these 5 individuals share. And the most prominent strand of that DNA, the absolute bedrock of their success, is their psychology of risk.
Oh, absolutely.
Every single one of them places loss avoidance entirely above the pursuit of profit.
Which sounds totally counterintuitive. You assume the greatest traders in the world are obsessed with making money.
Right. But they aren't. They are obsessed with not losing money.
Yes.
Look at the math of drawdowns. If you take a 10% loss on your capital, you need an 11% gain to get back to even. That's manageable.
Sure.
But if you take a 50% loss, you don't need a 50% gain to recover. You need a 100% gain just to get back to zero.
The math is brutal.
The mathematical hole becomes exponentially harder to climb out of. Elite traders understand that large losses permanently destroy compounding.
Think about the mechanisms we just discussed. Trout's non-negotiable 4% daily kill switch. Druckenmiller liquidating a massive 130% long position the moment the market proved his premise wrong.
Yeah.
Blake limiting his market exposure to a maximum of 4 days to minimize systemic risk. Standard human nature focuses on the upside. How much money can I make if I buy this?
Right, that's what everyone asks.
But the elite trader looks at a setup and asks, where exactly am I wrong, and what is my maximum catastrophic loss if everything falls apart?
They map out the worst-case scenario first.
Exactly. They know that if they surgically protect the downside, the upside will eventually take care of itself.
And that extreme risk control ties directly into the second recurring theme across all the sources, which is the necessity of doing the uncomfortable.
This is huge.
One of the traders interviewed in the broader book, William Eckhart, distills it perfectly. He says, if it feels good, don't do it.
Wow. The human brain, shaped by thousands of years of evolution, is hardwired to seek comfort and avoid pain.
Right.
In the financial markets, those exact evolutionary instincts are financially fatal. The brain wants to lock in small wins because it feels safe. The brain wants to hold on to losing positions because accepting the loss damages the ego.
These 5 traders achieve superhuman results by reprogramming their behavior to do the exact opposite.
Exactly.
They endure the excruciating pain of taking a loss immediately before it grows. They endure the severe psychological discomfort of buying a stock at a 60 PE ratio, like Driehaus, when the rest of the world thinks it's a bubble.
They fight their own instincts.
Yeah, they endure the agonizing anxiety of holding a massive, highly leveraged winning position to capture a macro trend, like Druckenmiller, rather than cashing out early to feel safe.
Normal human habits naturally gravitate toward the herd. And in the financial markets, the herd is slaughtered.
Surely is.
To win, you must execute what is mathematically correct, regardless of how terrifying it feels. Which brings us to the final, and perhaps most critical, takeaway from the text. Matching your personality to your methodology.
This is so important.
You cannot successfully trade Driehaus's explosive, high-volatility momentum strategy if you possess Monroe Trout's conservative, low drawdown personality.
Right?
If you lose sleep over a 2% drop in your portfolio, you cannot strap yourself into a small-cap tech fund that swings 10% a day. The methodology absolutely must fit the architecture of your own mind.
This is exactly why so many retail investors fail when they try to copy successful traders. We all want the shortcut.
Oh, everyone wants the shortcut.
We want to buy a subscription to someone else's algorithmic system, plug it into our brokerage account, and go play golf. But the sources overwhelmingly prove that buying someone else's system inevitably fails.
Every time.
Why? Because you did not build it, which means you do not have the psychological conviction to stick with it when it hits a drawdown. If you are naturally a highly analytical, cautious individual and you try to trade a high-octane trend-following system, the absolute second that system generates 3 losing trades in a row, your natural personality will override the system.
You'll panic.
You will abandon it right before it generates the massive winning trade. You have to trade in a way that does not create internal emotional friction.
And we see that internal friction completely destroy traders when they trade with what the industry calls scared money.
Scared money. Define that.
It's the acute, desperate need to win. There's a story from early in Stanley Druckenmiller's career that illustrates this perfectly.
Tell it.
Long before he was managing billions, the firm he was working for was in severe financial trouble. He desperately needed to generate massive returns to save the company and his own career.
So the pressure was on.
Massive pressure. Driven by desperation, he took a massive over-leveraged plunge into Treasury bill futures. Statistically, his entry point was brilliant. He bought them within 1 week of their all-time historic low.
Okay, so he was right.
He was. But he still lost all his money.
Wait, how? If he bought at the bottom.
He lost everything because the psychological need to win completely poisoned the execution of the trade.
Ah.
When you are desperate, when you are trading with capital, you cannot afford to lose, whether that's your mortgage payment or your firm's survival capital. All of your cognitive biases, emotional pitfalls are magnified 100-fold.
You lose your objectivity.
Completely. You use excessive leverage, you panic and sell at the slightest microscopic dip. You lack a clear, objective exit plan.
The market is an unmerciful enforcer of discipline.
It really is. It senses and punishes desperation. When your ego, your self-worth, or your immediate financial survival is entirely dependent on the outcome of a single trade, you have already lost your objective edge.
The old adage is mathematically true. Scared money never wins.
Never. So as we synthesize this entire journey, we have traversed from Druckenmiller's top-down global macro chess game to Driehaus's bottom-up high PE growth stocks. We examined the quantitative mutual fund arbitrage of Gil Blake, the fusion of statistical models and pit noise by Monroe Trout, and the 150-year historical cycle analysis of Al Weiss.
It's a lot of ground covered.
It is. But the unifying secret of the market wizard isn't the system itself. It is the absolute, unyielding, almost robotic discipline to follow that system.
Yes.
It is the complete eradication of ego required to admit a mistake instantly. And above all, it is the profound self-awareness to construct a strategy that flawlessly aligns with the trader's own psychological strengths and weaknesses.
And that leaves us with a critical, lingering question for you to consider long after this deep dive ends. We spend so much of our lives in finance, in business, in our careers, searching for the right answer from external sources.
We do. We're always looking for the guru.
We look for gurus, we buy books, we search for the magic algorithmic bullet, but the evidence clearly shows that the only system that will truly work is the one uniquely tailored to your own psychological architecture.
That's the real truth.
So think deeply about this. If you were suddenly handed a $10 million portfolio to manage tomorrow morning, which of your own deeply ingrained personality traits, your impatience, your need to be right, your fear of missing out, your aversion to loss would be your biggest liability in the market?
That's a scary thought for a lot of people.
It is. And how would you build a mechanical system to protect your capital from you? Because at the end of the day, when you are trying to extract wealth from the chaotic, muddy waters of the global markets, the most vital thing you must analyze isn't a chart.
No, it's not.
It's yourself. Thank you so much for joining us on this deep dive into the minds of the market wizards. Keep questioning your assumptions, keep learning, and we will see you next time.